So today we will discuss about intercompany bond transaction. When a parent or a subsidiary acquires bonds issued by the other, both the investment in bonds and bonds payable are eliminated in the consolidated financial statements. So sa investment in bonds and bonds payable ay may eliminate daw kapag na-acquired na yung bonds. The bonds payable are considered extinguished from the point of view of the group. Therefore, the difference between acquisition cost of the investment in bonds and the carrying amount of the bonds payable on the acquisition date is recognized as gain or loss in the consolidated statement of profit or loss. Letter B. Any interest expense and interest income recognized after the intercompany transaction are eliminated in the consolidated financial statements. So, sa interest expense and interest income na na-recognize daw ay ma-eliminate after the intercompany transaction. Let's go to the problem. On January 1, 20X1, Sing Company acquired 75% interest in Dance Company. On this date, Sing Company's net identifiable assets have a carrying amount of 200,000 equal to the fair value. So, equal daw sila. Non-controlling interest was measured using the proportionate share method. On December 31, 20X1, Dance Corporation purchased all of the outstanding bonds of Sing Company from the open market for 250. So, lahat daw pinurchase niya. There were no other intercompany transactions during the year. The year-end individual financial statements shows the following information. So, ito. Tapos ito. So, yung requirement. Compute for the gain or loss on extinguishment of bonds to be recognized in the 20X1 consolidated statement or profit or loss. Letter B. Compute for the consolidated total bonds payable. Letter C is prepare a draft of the 20X1 consolidated statement of financial position and the statement of profit or loss. So let's go to requirement A. So requirement A, compute for the gain or loss on extinguishment of bonds to be recognized in the 20X1 consolidated statement of profit or loss. So sabi natin kanina, ang pag-compute ng profit or loss is the difference between the carrying amount of bonds payable and the acquisition cost of the investment, which is equal to gain or loss. So, ang carrying amount natin is 300,000. 300,000. Ang acquisition date naman, ang acquisition cost naman is 250,000. Ito yung pinagbili niya. 250,000. So, 300,000 minus 250,000 is 50,000. So, this is a gain. Gain on extinguishment. So, ang sagot natin sa letter A is 50,000. Let's go to requirement B. Compute for the consolidated total bonds payable. So, sabi natin kanina, eliminate natin si bonds payable. So, ang carrying amount ng bonds payable natin is 300,000. So, ang eliminate natin, sabi dito, pinurchase niya lahat. So, purchase all of the outstanding bonds. So, lahat daw pinurchase niya. So, meaning, ang all is equals to 100%. So, ang eliminate natin is 100%. So, 300k times 100% is equals to 300k. So, eliminate natin yung 300k. So, 300 minus 300,000 is equal to 0. Kasi, lahat inacquired niya. So, lahat din ma-eliminate. So, ang sagot natin sa requirement B is 0.
Requirement letter C. Prepare a draft of the 20X1 consolidated statement of financial position and profit and loss. In step 1, we computed the gain on extinguishment, which is 50,000. Step 2, analysis of the subsidiary net asset. Since in the problem, it was stated that net asset at carrying amount equals net asset at fair value is equals or the same. So there is no fair value adjustment. We just need to get the carrying amount of the asset at January 1, 20X1 and December 31, 20X1, which is 200 and 270,000. The net change would be 70,000. Step number 3, computation of goodwill. The consideration transferred is 180,000, equal to the investment in subsidiary. Non-controlling interest is computed as 200,000, the fair value on January 1, 20X1, times 25%, the non-controlling interest percentage equals 50,000. Previously held equity interest is none, a total of 230,000, less the fair value of net identifiable assets, which is 200,000. The excess is goodwill, which is 30,000. Step number 4, computation of non-controlling interest. 270, the fair value on December 31, 20x1 times the 25% non-controlling interest, we get 67,500. Step number 5, consolidated retained earnings. The retained earnings attributed to parents only, which is 140,000. Gain on extinguishment, which pertain to parents only because the transaction or the issuer of the bond is parent, so the gain would only pertain to parent. Share in the net change is 70,000. We can get that in step number 2. 70,000 times the controlling interest of 75% of the parent, we get 52,500, a total of 242,500 for consolidated retained earnings. Step number 6, consolidated profit or loss. Profit before adjustment, parent, subsidiary, and consolidated. Parents is 80,000, subsidiary 20,000, consolidated 100,000. Effect of intercompany transaction, gain 50,000 to parents only, subsidiary none, consolidated 50,000. I skipped the depreciation and fair value adjustment since there is no fair value adjustment as stated in the problem. So I derived consolidated profit or loss as 120, a total of 150 consolidated profit or loss. So how much is attributed to parents and NCI? Parents' profit is 130. Parents only. Walang share si NCI because parents lang ang may-ari ng profit. So NCI is none. Consolidated is 130,000. Share in Dan's corporation or the subsidiary, 15,000 since parent has a 75% interest in the net asset of the subsidiary, 15,000, and 5,000 NCI. Total of 145,000 for parent, NCI of 5,000, and 150 consolidated. Now that we are done with the following step, we can now draft the consolidated financial position and profit or loss. Now that we are done with the following step, we can now draft the requirement letter C, which is the consolidated financial position and statement of profit or loss. Same group, consolidated financial position as December 31, 20x1. Asset, investment in subsidiary is eliminated. Investment in bond is eliminated because it was acquired in full. Other asset as 550,000 and goodwill of 30,000 computed in step number 3. A total asset of 580,000. Liabilities, account payable of 70,000. Bond payable was eliminated because it was acquired in full. Total liabilities of 70,000. Equity, share capital attributed to parent, retained earning computed and step number 5, and non-controlling interest computed in step number 4. A total of 510,000. 70,000 liabilities, 510,000 equity, a total of 580,000. Balance. Statement of profit or loss. The consolidated revenues is 420,000. Operating expense is 317,000. Profit before intercompany transaction of 103,000. Since the interest expense is added in the 317, we're going to eliminate it by deducting the 3,000 interest expense. Plus add the gain on extinguishment of bonds because in the definition, a gain or loss is recognized in the consolidated financial statement. So, we recognize the gain on extinguishment of 50,000. Profit for the year, total of 150,000. Profit attributable to the owners of parent, 145,000, 5,000. You can see this in step number 6.